Got that out of the way.
Yep.
So what I want to talk about, Lee, is how do mortgage markets work? Because a question that's now coming up is anybody that's kind of casually following the news, they hear about what's going on with the Fed, and the Fed is going to raise interest rates.
Right.
And then they go, well, they haven't raised them yet, but yet mortgage rates have gone up 1% in the last, just over a month. So how does that work? Why? There obviously is not a direct correlation to what the Fed does versus what mortgage rates do. So can you try to unwrap that a little bit?
Yeah, sure. So, at the heart of it, the mortgage movement is going to be based on what's happening in the economy. Typically,
Okay.
A lot of times when there's, unfortunately, when there's bad things that are happening and the markets are crashing and that kind of thing, and it's affecting, the stock market, the 10-year treasury rates tend to move down.
Okay.
And when things are doing well or inflation is up like it is now, then the rates start to move, right? But the thing is with mortgage rates, it's a lot of times based on emotion, okay? Things that are going to be happening, right? A lot of times, like with what's happening now with inflation and the talks, just the talks alone of, okay, the inflation is through the roof. We've had the biggest year-over-year increase in 40 years. That scares a lot of people because they know what's coming next. And what's coming next is the Fed raising the overnight rate, the Fed pulling back and not buying nearly as many mortgage-backed securities and really coming out of that market.
Yep.
And just the news of that, rates are based on emotion. And that's what drives it is emotion.
Yeah, and it's really so the mortgage rates. Well, let me just ask this. I'm not going to say it as a statement. I'm going to ask it as a question. Do mortgage rates really they're pricing in the future?
Exactly. They've priced it in. So what we're hearing now is that the Fed is considering a 50-point BIP increase, 50.5% increase to the overnight rate. Now, that's not the mortgage interest rate, or like if you're getting an auto loan or your interest rate on your credit card. That's not what that is.
Yeah.
But what it does do is it affects all of those rates. Okay.
Yeah.
Now, when we hear that there's going to be a 0.5% increase to the overnight rate, people panic, right? And they price it in.
Yeah.
When the emotion, they price it into the rate, and our rates start to move up. And they've moved up significantly because of the news of what the Fed is going to start to do here in March. By the time it actually happens, it's already been priced in, like you said.
Yeah.
And so we don't see nearly the same effect. So when it actually does happen.
So come March when they, some people are saying a half a point, some people are saying a quarter point, looks like everybody agrees they're going to raise it somewhat.
Right.
And the reason they're doing that is they want to slow down the economy to pull back on inflation.
Right.
Yeah.
With the news yesterday, the CPI and yesterday was a pretty big increase, 83 bips, which is pretty significant, 0.83% to some of the pricing, not necessarily the rate. But with the news of that, now there's a 44% chance that the Fed is going to increase it by 0.5%.
That would be big.
Increase,
that would be big. And I know there. If I follow all these economists on Twitter myself, that's one of my things I do, and it's really interesting the conversations and debates going on because nobody really knows. But what happens is what happened on Thursday when the inflation numbers came out. The market tanked. Mm-hmm. The 10-year treasury went up substantially. It went up over 2%, which was the first time in I don't know how long. Well,
I'd say
I got
probably
the chart right
at
here.
least probably over 2 years.
Let's
probably
see. Last time it was at 2% was 2019. Mm-hmm. And so let's talk about that actually. So if we look at 30-year fixed rate mortgages, they're somewhere around 4%. Is that fair to say?
Maybe even a little higher right now.
Maybe a little higher?
Yeah,
okay.
Yeah.
And the thing I thought was interesting about that, though, if you look back in history, we're basically back to where we were so let's say, January of 2020, pre-COVID.
Exactly. And that's the thing is we do need to change the narrative a little bit here, right? Because, yes, rates are definitely higher than they were a month ago. They're definitely higher than they were in 2021 and 2020, but they are back to where the direction we were headed, at the beginning of 2020, pre-COVID, and we're right at that same level again. So we're right back to where we were at.
The question I'm getting a lot lately is, are the higher mortgage rates going to slow down the housing market? And I think the answer is yes. I think the big question then is how much?
Right.
How much is it going to do it? How many buyers are going to be taken out of the market because now their mortgage. So we did a chart here. If you look at a $250,000 loan, let's say loan dollars, at 3% it was 1,054, and at 4%, or it's at let's say 1,200. So it's about $150 more per month.
Right. Yeah. And so that's what ends up happening is that when the rates move, then people are priced out of their homes or where they were looking, especially when their debt to income ratios are pretty tight. Now you're looking at, okay, one, your payment has gone up, or does that mean you can, now you have to buy less house? And we talked a little bit about, that type of an increase, a 1% increase in rate, which that's what it's been over the month.
Yep.
How much house can you buy now? And you probably lose about $30,000 in buying power.
Yeah. And it's interesting, Lee. I went back and looked at like 2018 when we had the mortgage surge. I think we had a surge in 2015. I'm trying to remember exactly where we had. We've had periods where mortgage rates went up really fast. Right. And I was curious to see if there was some correlation to home prices and then the number of home sales. And the thing that was interesting, I just looked at Albuquerque. There really wasn't a change.
No,
it really didn't. At least in those times, it did not take people out of buying. Statistically. Now the one variable that we have now that we didn't have then is we've had 2 years of price appreciation. Somewhere between 20 to 30% in 2 years. That's different. So it's gonna be curious to see. You said something. I just want to go back to it. You said debt to income, or what we always say, DTI. What do you mean by that? Because I think that's it's a very simple thing, I think. But if you've never shopped a mortgage, you have to understand that. So what is debt to income?
Debt to income ratio is your your total of all of your liabilities, your monthly obligations, based on the credit report, plus the proposed housing expense, the house that you're looking to purchase.
Okay. And
you take that and you divide it by your gross monthly qualifying income.
Okay.
And that gives us a percentage. Most loan products want you to stay, at or below 45%. That's, more ideal. You can usually push that up to 50% with, factors such as good credit and a really strong buyer. But, so typically you want to stay at about 45% debt to income ratio. So again, your total of your liabilities and the proposed housing expense divided by your gross monthly income.
Got it. Okay, got it. So let's just do the anecdotal thing. So here, Venturi Realty Group, we're here in Albuquerque. There's still a lot of buyers out there looking for homes. That's what we're seeing. We have not seen much change there.
Lots of pent-up demand.
Lots of pent-up demand. And so in the mortgage world, you guys do, a pre-qualification, a pre-approval process for people that are looking for homes. Have you seen much change there?
We haven't, no. In fact, what's happening now, it feels like we have a lot of people now feeling the rates going up, and the news definitely can help and hurt you, right?
Yeah.
And so with all the news of rates moving up as fast as they can, now there's a rush to say, we need to buy now. Because there's no, right now they don't know when these rates are going to stop moving, right? And they can continue. And so there's now been a rush of people that just say, like, I need to buy, I want to buy. And as you know, in this market, Albuquerque, and we talked about this before, that it's not just Albuquerque, but rents are through the roof.
Oh yeah. In fact, rents have gone up faster. That's one of the things that we hear a lot right now when we're talking about inflation and we're talking about housing costs and rental costs and shelter costs. Is real estate is actually a really good hedge against inflation,
right?
Because now somebody that bought a house a year ago, they're locked in at that monthly payment forever.
Right.
It doesn't get affected by inflation.
Right.
Like
rents do. Right.
Like rents do. Right. Now, of course, you could argue, yes, the value of the dollar is less that you're paying with and all that. Okay, I got that. I understand. But I'm just saying it, a real asset like real estate generally is a good hedge against inflation.
It really is. Yeah, it's one of the best hedges against inflation because it is going to continue to appreciate as inflation is up. So is that appreciation on the homes. And like you said, we've seen double-digit 20 to 30% increase in the Albuquerque area. That's going to continue. And so we've really been educating our borrowers, our pre-quals, to stay in the market. It's still a great time. Rates historically they're still low. Like we said,
Of course.
they're still the same level as they were in 2020 before pre-COVID. And appreciation is still there. It's going to continue. It's driven by supply and demand. And as the supply issues that we have, there's just not a whole lot of homes in the market currently, and we still have
boy, isn't that the truth?
Right? We have a lot of demand. That's going to drive prices up and continue to. This supply and demand issue that we have, or the supply issue that we have, isn't going to be over in the next. I don't feel like probably in the next couple of years, because it's such a big issue right now.
Yeah.
So why not secure that appreciating asset at a time when rates are still historically good?
Mm-hmm.
A lot of buyers do have short-term memory, and it's not as good as it was, like I said, a month ago.
Yeah.
But it is still a great time to buy.
So if you look at post, let's say, the Great Recession, right? The housing crash, whatever you want to call it, right? Coming out of 2010, 2011, 2012, mortgage rates came down a lot. Just same thing, right? The Fed did some stuff to stimulate the economy, all this stuff, right? So we've been in this 4%, 5% range for many, many years now.
Mm-hmm.
Yeah. And right now we're still, if you look at it again historically, we're at the lower end of that. Well, I'll call it the middle end of that range, because we have had 3% mortgages for the last 2 years. So anyway, I think we've beat up this mortgage thing enough.